Higher mortgage rates were supposed to lower home prices. They didn't. And once you understand how housing works, this result isn't surprising at all. So let's get into it. The first thing you need to understand is that higher rates, they didn't just kill demand, they also killed supply. And this is one of the most important points that people overlook. When rates went from about 3% to 7%, buyers absolutely felt it and it slowed down demand. But sellers felt something even bigger. Let's say you bought a home in 2021 with a $500,000 mortgage rate at 3%. Your payment might be around $2,100 a month. But if you were to sell today and buy a similar home and now your mortgage is at 7%, your monthly payments would be closer to $3,300 a month. That's over $1,000 more per month for the same house. So even people who want to move often decide not to when rates are higher. This is what's known as the mortgage lock-in effect. And when millions of homeowners do this at the same time, inventory collapses. So yes, higher rates reduce demand, but they also reduce supply. And when both things fall together, prices don't crash. Another thing people really misunderstand is how sellers behave. If a stock drops 10%, people panic and sell immediately. You see it all the time. But housing is very, very different. If a homeowner sees prices soften, they don't say, I need to sell today. They live there. They have time. They can wait. They can't even just sell today if they wanted to. So if a seller has a house on the market and they see prices coming down, instead of cutting prices aggressively, they often pull the listing and just wait for better conditions to sell. Or they just don't sell at all. That's why during periods of high mortgage rates, you usually see sales volume collapse, houses staying on the market longer, but prices staying relatively flat. Economists call this the downward price stickiness. In real life, it literally just means that people hate selling their house for less than they paid, and they'd rather just live in the house for longer than take a loss. Another key reason prices didn't fall is that the buyer pool, it didn't suddenly just disappear. It changed. When rates rose, average mortgage-dependent buyers were hit the hardest, but cash buyers weren't affected at all. In fact, higher rates actually helped them. There was less competition, more negotiating power, fewer bidding wars, and that means investors, high-income households, people selling one home and rolling equity into another, they could still buy and they kept prices supported. So even though affordability got worse for most people, there were still enough buyers at the top end of the market. And the housing market doesn't need everyone to be able to afford homes, just enough people to keep prices high. Now, you hear some people say, if prices are high, builders will just build more supply and prices will come back down. But housing supply moves incredibly slowly. Builders face a lot of challenges, including higher financing costs, higher labor costs, higher material costs, and tighter lending standards. And at the same time, existing homeowners weren't listing. So higher rates, they didn't just flood the market with new homes, they kind of froze it. And frozen markets, they don't create price collapses. They create something called standoffs. Another thing that people assume is that if homes are unaffordable, prices must fall. But affordability depends on rates and prices, not just prices. Rates can destroy affordability even if prices barely move, and that's exactly what happened. A lot of people's monthly payments skyrocketed even though prices stayed high. So the pain showed up in the payments, not in the prices. And that's why sales dropped so much, but prices didn't. Historically, large housing price drops require one thing: forced sellers. That means massive job losses, income shocks, adjustable rate resets, and over-leveraged homeowners. That's why 2008 was different. People couldn't wait. They had to sell. They literally could not afford the monthly payments on their homes. In this cycle that we're currently in, most homeowners have fixed rate loans. And they have equity on their homes, and most of them can afford their monthly payments. And without forced selling, higher rates alone usually just slow housing down. They don't break it. So what's the real takeaway from this video? It's that higher mortgage rates, they did not really lower home prices because a lot of homeowners were locked into low rate mortgages and they weren't willing to sell to lock into a higher rate mortgage at a new home. They really had no reason to panic. There was a lot of cash buyers that kept the market active, and there was really no waves of forced selling. And that's why prices stayed high even when buying a home felt impossible.